Bonds are also called fixed income. It means that its reward is as stable as the fixed deposit. What is a bond? A bond is a kind of a receipt for a loan. The issuer promises to pay a fixed interest before maturity, and when maturity, the principal of the face value will be paid off at one time. Therefore, bonds can be regarded as an investment tool that can stable interest. The nature of bonds is very similar to that of fixed deposits, and they can receive fixed interest every period. The difference is that fixed deposits are almost not dangerous, while bonds may have the risk of not getting interest. Because of its different nature, it is usually used to maintain capital and establish asset allocation when investing. The current bond rate of return varies according to the level of risk and the length of maturity. The long-term annualized rate of return of bonds falls between 3% and 6%. This figure is affected by the benchmark interest rate at the time. The overall return is slightly lower than that of stocks but is stable. The fluctuation is relatively small. When investing in bonds, we only care about one thing, that is, are the interest and principal paid? If the interest or principal cannot be paid, it is called a bond default. The difference with stocks is that if the company's operating conditions are poor, stock prices will fall, and future returns will also decrease. However, no matter how poor the company's operating conditions, bonds can receive interest and get them back when they are due, if the interest is still available and does not go bankrupt. The principal and the value of the bond are not affected. If the company does not repay the debt, it will enter debt negotiation. Some will continue to operate after negotiating with the bank, and some will go bankrupt and liquidate the company's assets. If it is liquidated, bond investors usually have the priority to get the debt back. But usually, it's not always possible to get them all back. The higher the risk, the higher the reward, but when investing in bonds, you should avoid taking risks as much as possible. Since the loss of not getting back the principal is too great, you should invest in some relatively stable companies and countries when choosing bonds. When the safer the institution is to issue bonds, the lower the interest rate can be set, and everyone will accept it. For example, U.S. Treasury bonds. But the riskier institutions are issuing bonds. The higher interest rates must be offered before anyone is willing to invest. For example, high-yield bonds. Because there are many bonds, there is only one real difference, high or low risk. Therefore, we will classify bonds. Even if we don't know the name of the bond, we can quickly know whether the relative risk is high or low based on its category. Classified according to the released objects. 1. Treasury bonds, government bonds or public bonds, bonds issued by the state. 2. Corporate bonds, bonds issued by the company. The reason is that the company or the country will have some investment that needs to be liquid, and the bank may not be able to provide sufficient financing. It may be that the amount is too large or the interest rate is too high. Therefore, it will issue bonds to others and promise to pay fixed interest in the future. Treasury bonds are generally less risky than corporate bonds, but countries with many unrest or economic problems are exceptions, such as Venezuela. And corporate bonds can also be subdivided, such as corporate bonds in financial stocks, corporate bonds in people's livelihoods, and so on. According to the region. 1. U.S. bonds, U.S. companies or U.S. government bonds, usually bonds with relatively low risk. 2. Developed market bonds, UK, Germany, Japan, Australia. 3. Emerging market bonds, China, Russia, India, Brazil, Indonesia, South Africa, Taiwan. According to the risk level. 1. Investment-grade bonds, most of the developed country treasury bonds and some large corporate bonds fall into this category. 2. Junk bonds, also known as high-yield bonds, mostly corporate bonds. Quick summary of bonds. 1. Bond is an investment tool that receives fixed coupons and repays the principal according to the denomination at maturity. 2. The most important thing to invest in bonds is to pay attention to risk, that is, whether it will default. 3. The most important thing to invest in bonds is to look at its risk and yield. 4. You can buy a basket of bonds at a time through bond ETFs or bond funds. Or you can buy bonds alone.